Okay, good morning, everyone, and welcome to MacroAce with your host, Tony. Going through PPI, we haven't been through PPI in quite a long while, but it's quite important before the main event tomorrow for CPI. It could set the tone for whether if PPI does continue, if it does rise, and that causes a risk-off reaction within the markets where equities take a hit, the dollar sees a jump, then as said, it could prove a worse tone for tomorrow for CPI data. But we've got about 15 minutes, so let's quickly get through the prep. Now, how does it affect the markets? So usually with a stronger than expected data from the PPI, we expect stronger reaction from the dollar in anticipation that the central bank is going to hold off on raising interest rates, keeping them higher for longer. In a normal market environment where the central bank isn't doing any hiking or isn't looking to cut rates, then usually when the economy is growing, then the dollar still tends to strengthen. Next, with the stock market. So if inflation rises sharply within a month, that can lead to stocks taking a hit. Again, similar scenario to the dollar. If the data is stronger than expected, central banks can take longer to cut rates, and in turn, stocks can see a decline instead of a rise. And for the bonds, high inflation reads can lead to high yields in an expansionary environment. And same thing here. It's all to do with how the central bank views the data, not only today, but also tomorrow as well, whether inflation is still sticky and whether there is more work that needs to be done to try and keep inflation from continuing to rise again. Remember, so the key differences with the PPI and the CPI. PPI is measuring how much producers are paying for goods and services that they use to make the products or provide services, and CPI is looking at consumer prices. But where is the economy at the moment then? So employment cost at 1.2% compared to 0.9%, inflation at 3.5% compared to 3.2%, core data for CPI unchanged at 3.8%, manufacturing prices paid for the ISM at 60.9 compared to 55.8, services prices paid at 59.2 compared to 53.4. So these two components, the prices paid for the ISM data, is quite key to producers of goods and services, because if you do see prices rising in those areas, then eventually down the line, if you continue to see a rise in those figures, that will then have an impact on the PPI data. And then as you continue to see a rise in the PPI data, eventually along the line or further down the line, you could see a rise in the CPI data. So it's not instant. If the PPI rises 1 month, then the CPI is going to rise the following the CPI is going to rise the following month after that. Usually it takes a bit of time for producers of goods and services to then pass on those prices to consumers. But of course, in this environment where everyone is laser focused on inflation data everywhere, then PPI still, and has recently for the last couple of months now, has provided a decent market reaction. Hence, we're looking at it here in the live stream and going through the prep. If you have seen in the deviation sheet before, that it has been updated with the figures of how the market has reacted to the PPI data. If we look at import and export prices, imports ticked up to 2.4, exports ticked down to 0.3. PPI at 2.1 compared to 1.6, and core rose as well to 2.4 compared to 2%. Industrial production unchanged at 0.4%, and manufacturing output had seen a decline at 2.5% compared to 0.8% for the month-on-month figure. Then, if we look at the next area, so as said, it measures prices that suppliers charge businesses and other customers. As I said, it can be an indicator for CPI. And the different things that are measured are crude goods, which is wheat, cattle, soybean, coal, crude, sand, and timber. You have your intermediate goods of the halfway finished products, and then the finished goods, which are furnished goods, which are the final product, which is then sold on to consumers. Of course, you can have other parts for the intermediate goods that can also be sold on to consumers, but Most of the PPI inflation comes from the finished goods, which is then passed on to the consumers, and then feeds into the consumer price index. So food and energy makes up about 40% of the finished PPI reports. That's the report in total. Then the previous report in March, the month-on-month data leading the broad-based March increase were prices for final demand services, less excluding trade, transportation, and warehousing. A major factor in March increase in price of final demand services was the index for securities brokerage, dealing, investment advice, and related services, which rose 3.1%. Sentiment and views then. So post the PPI data last time round, US short-term interest rate futures rose after the data and the unemployment insurance reports. Morgan Stanley on the 13th of May, or at the beginning of this week, they said that they expect headline PPI to rise by 0.3% month-on-month in April after 0.2% in March, which core prices are expected to remain steady at 0.2% month-on-month. Credit aggregators said that the dollar could suffer to the extent that today's US data and Fed speak encourage rate investors to front-load rate cuts, and this undermines the currency's relative rate appeal while giving global risk sentiment a boost. And then Lloyd's, they say that headline PPI inflation is expected to rise, led by higher energy prices, and rate setters will be mindful that disinflation has made little progress so far this year. So as said, you do have the main event tomorrow for CPI. A lot of the investment banks that we've picked out here today, looking at the expectation that if PPI does decline, then that could provide a risk-on reaction to the markets, where traders will see that that they will take it in a short-term reaction that inflation in the producer side is declining, and then maybe tomorrow the CPI could do the same too, could see a decline, and then that will provide the Fed with the means to say, okay, maybe instead of looking at a September rate cut, maybe they could pull it back to something sooner rather than later. June, more or less still out of the picture, but July Fed rate cut could come back into play. You do have Goldman Sachs that do see a Fed rate cut happening in July, and then seeing another two for the rest of the year, so 3 in total. But if PPI were to come in much stronger than expected, then that will lead to markets potentially only making a stronger pricing for 2 rate cuts. That could be September and then a skip, and then September and November, or maybe, depending on how strong it is, maybe even just seeing 1 rate cut for the year. Now that's very unlikely to happen considering it's not the main event, but it can help steer markets sentiment for the rest of the day before the CPI data, that there could be a worse tone for the market, so more of a risk-off market that could then be presented. All right, so this was some comments from Goolsby. So we had Goolsby saying that if uptick in inflation means overheating, the Fed has to do whatever to get inflation to 2%. Barkin said that I'm looking for inflation progress to sustain and broaden. Kashkari says the bar is high for another rate hike, but can't rule it out on CNBC. Bowman said, I don't see rate cuts as warranted this year, and if we saw unexpected shocks, that would be a case for a rate cut. And Fed's Logan said that it is too early to think about cutting rates. Looking at the deviations then, and what we're expecting, what the markets, what the investment banks are looking at, median expectations. So the median forecast at 2.2% with a high estimate of 2.3 and a low of 2.1. So looking at 0.1% deviation on either end. Core PPI year on year, again, high estimate of 2, more or less looking at a 0.1% deviation on the low end and 0.2 on the high end, with a high estimate of 2.5 and a low of 2.2. Core PPI month-to-month, high estimate of 0.3 with a low estimate of 0.1, with a 0.1% deviation on either side, and PPI month on month with a high estimate of 0.4% and a low estimate of 0%. So 0.3% deviation on the low end and a 0.1% deviation on the high end. So then this is the market reaction that we had seen last time round from the stronger than expected data. Mungus McTavish, you're back. Here's your badge and gun. You can go back on the beat now. Anyway, so here's the market reaction that we had seen last time round. The dollar had seen a decline from the PPI data that we had seen last time round. S&P had seen an increase there, and US 2-year yields, 2-year government bond yields had seen a decline as well. So the price of that bond would have gone higher. So remember, with bonds, the higher the yield, the lower the price, and vice versa. Okay. All right, so let's quickly have a look at the deviations then for how the markets had reacted, what the main players are. So if you have access to this, then you would have already seen it, but this is the market reaction that we had last time round. You can see that the currency space doesn't really see too much of a market reaction compared to the index, the stock indexes. So of course, with the NQ, they're having the biggest reaction out of those equity indexes, but of course carries more risk. But yeah, here we go. If we're looking at the currency pairs, then we're looking. Dollar yen didn't really see that strong of a reaction compared to initial reaction compared to the likes of, let's see, cable. But it was still, in the past, generally, there has been a bit of a chop between dollar yen and GBP USD that have seen the biggest market reactions or have been more sensitive. Now, with the central bank in Japan looking to raise rates one more time this year potentially, that's what markets are expecting. That could mean that if the yen, and also with the interventions that have taken place by the Japanese government, then that means that the dollar yen has more risk of a potential intervention if the Japanese government decides to intervene, and could moderate then the overall size of the reaction on the dollar yen. So you might have to look at other areas like GBP USD, or look to the risk on currencies with the dollar, or with the Canadian dollar, New Zealand dollar, and Aussie dollar, albeit they don't really have that much of a reaction compared to cable and the euro dollar. So dollar yen, keep an eye out for. Euro dollar, and so you have cable that's going to potentially have the better reaction, and euro dollar being second there, but doesn't mean that the dollar yen can't also have a decent reaction too. But just historically, of what we've had so far in the past and how it's performed recently, it's been a bit more mixed. Okay, so let's get this out of the way. We've got our markets. We've got our release ready. So what will happen? Also, don't forget, if you like the video, subscribe to the channel, get the word out there, and also don't forget to sign up to the MacroAce mailing list, which I'll put out for the list, or put out in the comments there for you in a bit. Month to month, are you guys? Did you guys want to have a look at the data again? Well, we've got about less than a minute now. So here we go. So for the month on month, you're looking for high estimate of spot 4% and low end of 0%. Core PPI month on month of 0.3 and a low estimate of 0.1. Yeah, so if it's higher or low, if it's higher than the max figure, if PPI is stronger than expected, then you're expecting a weaker reaction. You're expecting a bearish reaction from the stock indexes. If it's lower than expected, or if it's lower than the low expectation, or if it's much lower than expected, you're expecting a more bullish reaction from the equity indexes or stock indexes. Dollar higher than expected would export. We got 10 seconds, but yeah, stronger reaction if you get a higher read from the PPI data, and a bearish reaction if you get a weaker read from the PPI data. Okay, let's see how this works. Okay, Okay, 2.2% as expected for PPI year on year. Other areas, okay, so PPI stronger on the month-on-month. Core PPI also stronger than expected. And the core PPI month-on-month also stronger than expected. So let's see if we can catch another area. Let's get TICKSTRIKE up and running. Okay. Hopefully that was kind of enough for you guys in the little short term that I provided. What else we got here? So bit of a still down, so pullback from that initial spike there. Let's see if the momentum is going to continue. TICKSTRIKE is showing some buying momentum creeping in to the equity indexes, to the stock indexes. For a little bit, but it's not. Okay. Let's see if the sentiment has shifted, what the sentiment is like for rates, and that might give us a bit more clarity. Okay, traders pair bets on Fed rate cut in September. Okay, so that's all right. So that's moving out of the picture slowly, and that's still keeping some of that pressure, some of the move towards the downside there. I think now a bit of a pullback. Don't forget with the CPI tomorrow, which we have is going to be, as said, the main event. The market reaction here. Let's have a look at the S&P. See how much of a market reaction we had. Okay, it's about a whoops. This will be about 127 there. All right. Okay, what else have we got here? We got Arno with a FJ Elite. So go month-to-month measures were much hotter than expected, but year-on-year measures were in line with expectation. Had downward revisions to the prior. Okay. Let's see, we got revised. So PPI year-on-year revised at 2.1%. What else have we got? Revisions on the revisions on the month-to-month, PPI month-to-month, minus 0.1%. We don't have any other revision areas. See. So zoom. A bit better. So year-on-year, prior revised to 1.8 to be lower. Okay. PPI final demand month-to-month also prior revised on the X food and energy or core year-on-year. So if the prior was revised for the year-on-year to 1.8 and it's coming in at 2.2%, then that's not that great. If PPI data is stronger than expected overall, but see if we get anything else. So getting a bit of a pullback on the dollar yen. See what gold did. Yeah, gold's pulling back itself too. Okay, let me get the live stream link for CPI and pop that in the chat for you guys here to be able to have a look at. Also, don't forget, if you enjoy the video, if you found it useful, don't forget to subscribe to the channel, get the word out there, and also give the video a like as well. Let's grab that here. Okay. Bing. Okay, there we go. So that is the link for tomorrow. Okay, continuing to see a bit of that pullback there. But yes, so as I said, FinancialJuice is where we had the data coming out live. So if you, let me kind of explain what FinancialJuice is. Actually, let me explain TICKSTRIKE, because that's where you can see all this red and green that you're probably thinking, what the heck is that all about? So what it shows is TICKSTRIKE allows you to listen in and see how strong the buying or selling momentum is within an asset. And that could be within Forex, crypto, stocks, futures, internals like your ADD or your VIX, and also ETFs and ETNs as well. So what TICKSTRIKE, if I was to bring up a little box here, let me show you what these boxes mean. So this box here is called a ticker box. And this represents the strength in the buying and selling momentum of that current asset that we're looking at. Okay, so if we're looking at the S&P here, you can see that when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will give you that visual and audio alert to that. All right. Now, one other thing to note with TICKSTRIKE as well is here you have these different numbers. And what these numbers represent is the sensitivity of that ticker box. So one is the most sensitive to market reactions. So when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will give you a visual and audio alert, or you can decide to choose whether visual or audio. Now, if I were to slide that number up, or slide this up all the way to 15, 15 is the least sensitive to market reactions. So only when there's only when there's a lot of buying or selling momentum that occurs, only then will TICKSTRIKE give you a visual and audio alert. And you can kind of chop and change between what you want to, what works for you. Okay. So 15 is the least sensitive, and as I said, only when there's a big amount of buying or selling momentum that occurs, TICKSTRIKE will then give you a visual audio alert. The other thing to bear in mind is that if you're scalping the markets and you're a hardcore scalper and you want to capitalize on every little bit of opportunity here and there, then we have this lightning bolt symbol. So the lightning bolt symbol, what it represents is when there's So lightning bolt symbol, if level 1 is most sensitive to market reactions, the lightning bolt symbol goes 15 levels below that. So that makes TICKSTRIKE uber sensitive to the markets, to the market reactions that are occurring. And you will see this. So every little bit of buying or selling momentum that is occurring, TICKSTRIKE will give you a visual and audio alert to it, as you can see here, with the S&P on the ES. Okay. All right. So that is TICKSTRIKE there. So if you want to have if you want to use TICKSTRIKE or get access to it, all you got to do is follow this link here, which I'll put in the chat. All right. Bing. That's put in the chat there for you guys to have a little look at. And even if you're, so I'll close TICKSTRIKE and get that out of the way, because now I want to show you the site. So if you're not ready, or if you're not comfortable with paying for TICKSTRIKE just yet, then on the website there is a more restricted version of TICKSTRIKE, but what it allows you to do is to get a sense of how it works and how it could be part of your day trading. So you have the S&P, Eurodollar, oil, and Bitcoin on here. And one of the other things you can do as well, it is restricted to, I think, level of sensitivity at 6, of course, which you can't chop and change. But as said, it gives you that level of experience to see what it's like. Will it work for you or will it not? Is it something that you want to have a little play around with, or is it something you want to add to your day trading experience? If not, then fine, that's perfectly all right. But if it does seem like something that's going to work for you, then you would have at least had a bit of a play with the free version and then go on to the pro version. Okay, now FinancialJuice. If you're a day trader and you're looking to capitalize on those opportunities that appear within the markets, then FinancialJuice provides you with what you need all in one place. Having a live voice and text service all in one place with your economic calendar here on the left-hand side. As said, your news or your text headlines that are here on the news feed in the center. Okay. And then here on the right-hand side, top right, you should be able to see it, is the voice where the person on the mic will tell you or read the economic releases, read the headlines, keep you up to date with anything that's going on within the markets. If there's been a particular headline being said, of course, we have Powell later today. If he says something that is seen as very dovish or very hawkish, then they would have, the person on the mic would have said it. And then if there was a market reaction, then you would be in the know. That's the key thing, is being in the know as to why the markets have moved. That's the key thing, is that for a day trader, yeah, of course, you can just look at the chart and then trade it. But then what if there's something underneath that market reaction that's caused, that is the cause of it, and it can actually have bigger implications or could provide a stronger downside move or upside move? Being in the know as to what's going on is the key thing with trading the news or day trading. Having that voice and text in the back of your mind there, or there in front of you, gives you that extra level of detail that you will need to then capitalize on potential opportunities or manage your risk within the markets if things are if sentiment has shifted just like that into another direction. So that is FinancialJuice, and we currently have an offer at the moment. So that's the pro version of FinancialJuice. So we currently have an offer at the moment. If you would like FinancialJuice, okay, for $99 a year rather than $1,200 a year, that's right. Instead of paying $1,200 a year, you can pay $99 for a year's worth of subscription to FinancialJuice with our promo code Juicy92. Again, that's Juicy92 to get FJ for 1 year for $99 with a 92% discount. Okay? So if you want access to that with FinancialJuice, with the pro version, then the link is there and the promo code is here. Now, first, bear in mind, what you've got to do if you don't have a FinancialJuice account is make the initial account on FinancialJuice, which will bring up the light version. Okay, the light version of FinancialJuice, there is a delay to the service and to the site, to the news feed. The economic releases, as said, that's everything. That's the news feed, the economic calendar, the voice, TICKSTRIKE as well. There's also a delay to that on the light version of FinancialJuice. There are adverts that are played as well on there. It's still useful, but if you want the pro version, first you need to sign up to the live version, verify your account through your email. Once you've verified your account from your email, then go to and then pay for the subscription that you want. Once you've done that, sign out, sign back in, and then you should get the pro version of FinancialJuice. So this link, I know I've posted a bunch of links, but this link here at the bottom, the last one I've put, if you don't have a FinancialJuice account, go to that link there, sign up to FinancialJuice, so it'll be the live version, and then go through with the pinned comment that I have in the chat. All right, ladies and gents, thank you. Also, the final thing is if you wanted access to the ranges and deviations sheet, okay, here we've got the ranges there. We've got the past reaction for the PPI data, CPI data. It's here too. I will share this with you today. Of course, anyone who subscribes to the MacroAce mailing list today will get an email on Monday, and then you'll get access to the mailing list. You'll get access to the deviations that way. Okay, so of course with CPI tomorrow, you have again, you can see with the ranges and deviations the past reaction of the CPI economic release, how it's performed, and then make your own informed decision as to how you're going to trade it. What deviation are you looking for to then make your trading decision? Okay, so let's go to, if I've put the link here, let me grab it up. Okay, so of course, if you sign up to the MacroAce mailing list and you get the email Monday, you'll be able to have access to the spreadsheet. Okay, that's the link there to sign up. Access to the spreadsheet and be able to see it and have a look around. That's also updated in real time as well. Of course, I'm doing this live stream, so I'm not doing it at the moment, but that is all there for you to have a look at. There are different economic releases that we have added, some new ones, New Zealand CPI, Australian CPI, UK CPI data that we've added to the spreadsheet if you haven't seen them before, and also the US employment cost data as well. That's all there as well. Some economic releases we might have covered in the past, as you'll see, maybe with the ADP employment change, but then the market reactions kind of died off, so you don't really get that much of a market reaction, and then the focus shifts to another economic release or other economic releases until we get a decent market reaction from it. Just like the PPI release that we had today, the market reaction in the past was quite lackluster. So there'll be times where here you had huge deviations, right? But the markets weren't really focused on it at that point. Hence, the market reaction wasn't that great. So we didn't carry on looking at it on the live streams, or even taking a look at it, or even putting it into the deviations and ranges, because the market reactions were very small and minimal. We couldn't really capitalize on the opportunity and make the most of that opportunity as you could, unlike today. Okay. So, right, that's the access to ranges and deviations. The link that's been posted there. Let me just show you an example of the email as well. That's also pretty cool that we have, or the email that we provide with the ranges and deviations sheet. I'll show you an example of what it looks like. So here is what we had for the email last week, where we had a rundown of what to expect in Asia, Europe, and the US session, a review of what had happened in the past week, also in the markets, commodities, bonds, and FX. That's part of the FJ Elite package, but still useful to have an understanding of that there, and a summary of the news so far as well. And then you have your link to your live streams there. So that's one email a week, not a daily update, okay? Just to make that clear, it's one email a week that we get an update for that you guys get an update from MacroAce, okay, providing you with what to expect for the week ahead and a summary of the week so far. Okay, ladies and gents, thank you very much for joining me today. I will see you guys tomorrow at 8 a.m. Eastern Time for CPI Big Boy event. Time for your big boy pants. And I will see you then.